Today, we'll look at the top 7 candlestick patterns, beginning with the basics and progressing to more complicated formations. We will also show how to combine these patterns with price action to find high probability trading opportunities. Get ready for an in-depth look of candlesticks. Let's dive in. What are candlesticks? Candlestick charts are a simple way to examine an asset's historical price. Each candlestick reflects the asset's price change over a given period of time. For example, on a daily chart, a single candle represents one day's price action. On the chart, we see two sorts of candles, green and red. When the closing price exceeds the beginning price, a green candle appears, suggesting that buyers outnumbered sellers at the time. In contrast, a red candle forms when the closing price is lower than the beginning price, indicating that sellers outnumbered purchasers. The reason most traders favor candlesticks is that they provide a better knowledge of price movement. A candlestick has two primary parts, the wicks or shadows and the body. The end of the upper wick represents the maximum price achieved during that time, while the end of the lower wick represents the lowest price reached during that time. When it gets to the candle body, the details start to vary. For green candles, the lower end of the body symbolizes the opening price, and the upper end represents the closing price. In contrast, red candles have the top end of the body as the beginning price and the lower end as the closing price. Before we go into candlestick patterns, it's important to understand a few fundamental notions regarding candles. Concept 1. Big versus small body. The body of a candle can indicate a lot about the buyer and seller's strengths and shortcomings. For example, consider two green candles. The candle on the left has a large body and relatively short wicks. The price has dropped here. Initially, the sellers attempted to lower the price, but they were ineffective. But as purchasers rapidly stepped in and drove the price up, the buyers were able to dramatically increase the price without much protest from the sellers. As a result, the price finished quite close to the high, indicating that the buyers outperformed the sellers during this candle. The second candle has a different narrative. The price opened here, and purchasers began to drive the price upward. They were able to lift the price to a new high, but at that moment, the sellers stepped in and pushed it down. The sellers were strong and nearly brought the price back to the opening level, but the buyers only managed to keep the price above the open. In this instance, the buyers were stronger than the sellers, although the difference was small. When a candle's body is greater than the wicks, it suggests that either the buyers or the sellers had power. When the body is smaller than the wicks, it indicates that neither side had much influence, implying a difficult contest between buyers and sellers. Concept 2. Large wicks. A large wick above or below the body is a strong indicator of price activity. If there is a huge wick above the body, it signals strong selling pressure at those levels, implying that buyers will have to exert significant effort to drive the price higher. In contrast, a huge wick below the body indicates significant buying pressure, implying that sellers will need to outbid these buyers in order to force the price lower. Understanding the notions of body and wick is critical as we progress. Keep them in mind when we look at some basic candlestick patterns. If you're enjoying this video so far, please like it and subscribe to our channel TraderYodha for more videos like this. Basic patterns. Pattern number 1. Bullish pin bar. A bullish pin bar is a strong reversal candlestick pattern that suggests a possible upward reversal. It consists of three parts: a little green body, a huge wick beneath the body, and a tiny or non-existent wick above the body. A bullish pin bar indicates that the price opened around this area, and sellers quickly attempted to push prices lower. They succeeded in driving prices lower, but the decreased prices eventually sparked buy orders from buyers. The buyers, being substantially stronger than the sellers, pushed the price over the open. As a result, the purchasers traveled a greater distance than the sellers, showing that they have interfered and are looking to raise the price. If a pin bar comes after a strong downturn, It indicates that the sellers have lost momentum and buyers are now moving in to push the market higher. To trade the pin bar, we must hunt for other meetings that reinforce our bias. We'll get into those confluences or meetings later, but if we see a purchasing opportunity with a pin bar, we can put a buy order above the pin bar's high. We can set our stop loss below the pin bar and aim for the following resistance level. Pattern 2. Bearish pin bar. The bearish pin bar is the inverse of a bullish pin bar. It is a red candle with a little body, a large wick above it, and a tiny or non-existent wick underneath it. This pattern implies a potential downward reversal. The psychology of the bearish pin bar is obvious. The price opened at this point, and buyers first pushed the market upward, resulting in a high. However, sellers joined in, sending prices lower and passing below the opening price. The sellers successfully kept the price low, and the candle closed near its lows. This means that sellers have obtained a temporary advantage over the purchasers. If we find another confluence at this point, we can enter a sell trade below the low of the pin bar and set our stop loss right above the pin bar. Pattern 3. Doji. The doji pattern is perhaps the only candlestick pattern that does not have a directional bias. However, knowing this pattern is critical. A doji candle is distinguished by having roughly equal wicks above and below a small body. The open and close are located at the center of the candle, and the candle's body is very small. This trend suggests that buyers and sellers were quite competitive during that time period. The sellers attempted to lower the prices, but the buyers raised them. Finally, they were equal, and the price closed close to its opening price. The doji alone does not indicate any specific direction. It can imply a brief stop in the movement. However, seeing numerous doji candles in a row indicates that buyers and sellers are fighting for dominance. Typically, such a pattern results in a big move in either direction. So keep this in mind. So far, we've examined 3 patterns that use a single candle. Now we'll move on to intermediate patterns with 2 candles. Pattern 4. Bullish engulfing bar. A bullish engulfing bar is a 2-candle pattern in which the green candle totally engulfs the red candle that came before it. This design begins with a red candle, followed by a larger green candle that totally covers the red. In this pattern, the green candle has a higher high than the red candle and a lower low. During the red candle, sellers took control, sending the price lower. When the new candle opened, sellers immediately drove the price lower, breaking the previous low. However, buyers rushed in, overwhelming the sellers and pushing the price over the previous red candle's peak. This suggests that the buyers traveled a longer distance than the sellers, implying that they were now in control and ready to raise the price. For entry, we put an order at the break of the green candle's high, with a stop loss placed below the candle's low. As previously stated, other confluences, such as price action, must be observed to verify the trading pattern. Pattern 5. Bearish engulfing bar. A bearish engulfing bar is a 2-candle formation in which a big red candle totally covers the previous green candle. This pattern starts with a green candle, followed by a larger red candle that completely covers the green one. The red candle has a lower low than the previous green candle and a higher high than the prior candle. To comprehend the psychology behind this trend, examine the following. Initially, the buyers had control, as demonstrated by the green candle. However, when the following candle opens, buyers strive to drive the price higher, eventually surpassing the previous candle's high. At this moment, sellers see the fresh highs as an opportunity and start selling aggressively. The selling pressure gets so fierce that the price falls below the low of the preceding green candle. The sellers travel a longer distance than the buyers, indicating that they have now acquired control of the market. As a result, we can place a sell order below the low of this candle and set our stop loss at the high of the bearish engulfing bar. Now we'll move on to more complex patterns. Pattern 6. Morning Star Pattern. The Morning Star pattern is a 3-candle structure that indicates a positive price reversal. The pattern begins with a powerful red candle with a large body. The second candle is a doji or pin bar with a small body and large wicks, which might be red or green. Finally, the pattern is completed with a huge green candle that rises over the height of the doji or pin bar candle. The size of the last green candle is critical to judging the pattern's power. If the green candle is as large as the red candle, this indicates a good trade opportunity. If it is smaller, the transaction has a reduced likelihood. Finally, if the green candle closes above the high of the red candle, it signifies a strong reversal. The Morning Star pattern's psychology is rather basic. Initially, the red candle indicates that sellers had complete control, pushing prices lower. This is followed by a small doji candle, which signals that buyers have begun to enter the market and push prices higher. Eventually, the sellers lose strength and the purchasers force the price higher, resulting in the enormous green candle. This pattern indicates that buyers have reversed the situation and are likely to drive prices higher. To trade this pattern, place a buy order above the peak of the green candle and a stop loss below the doji candle. Pattern 7. Evening Star Pattern. The Evening Star pattern is exactly the opposite of the Morning Star design. It consists of 3 candles, a large green candle, a small doji candle with a very small body, and a large red candle. The buyers were initially in control, as seen by the huge green candle. Sellers soon entered the market and challenged the purchasers, as represented by the doji candle. The doji candle indicates a tug-of-war between buyers and sellers. Eventually, the sellers gained the upper hand and forced the price down, resulting in a giant red candle. To enter a sell trade using the Evening Star pattern, position your sell order below the low of the red candle and your stop loss above the doji candle. These 7 candlestick patterns are useful in detecting trade opportunities. However, we are not yet finished. Next, we'll look at how to employ price action concepts to locate the best entries for these patterns. To integrate candlestick patterns with price movement, we'll use support and resistance levels, as well as trend lines. For example, suppose the price was in a downturn, but found support in a specific area. We see 2 reversals at this level and classify it as a support level. When the price reaches this support level for the 3rd time, we expect it to find support, but we'll need to wait for candlestick confirmation. As the price approaches support, the candles become smaller, indicating that sellers are losing momentum. Then, a doji candle appears at the support level, offering additional confirmation. This doji is followed by a massive green candle, indicating that buyers have seized control and are preparing to push the price upward. The green candle completed a Morning Star pattern, indicating a strong signal because it broke above the highs of both the doji candle and the red candle that came before it. As a result, a purchase order might be put above the high of the green candle, with a stop loss set below the doji candle. This trade's aim is the previous high. As you can see, the price rose when we entered. Even if you missed the first admission, the price offered a second chance. The price reached 2 peaks, forming a firm trend line. When the price neared the trend line again, we looked for confirmation in the shape of patterns. A red candle at the trend line indicated that sellers were seeking to provide resistance. This red candle was followed by a big green candle that totally consumed the previous red candle, forming a bullish engulfing pattern. The green candle had a lower low than the red flame and a higher peak. This is a clear sign that buyers have taken control, and the trend line's significance has reduced. A buy trade could be started here as well. Place a buy order above the green candle's high and a stop loss below it. This trade's targets would be prior highs. As seen, the pricing met these targets. For a sell trade example, consider how the price found resistance in a specific area. On the second test of this resistance, the price produced an evening star pattern, which included a green candle, a doji, and a massive red candle. The red candle was so huge that it closed far below the lows of the preceding two candles, indicating a high likelihood pattern. As a result, a sell trade was initiated at the low of this red candle, with the stop loss set above its peak. Targets were set at the previous two lows, and the price met them. Warning: it is crucial to understand that candlestick patterns are not foolproof and should be used alongside other analysis methods. I believe you now have a clear knowledge of how to use these candlestick patterns in your trading. Remember that candlesticks are just one component of the puzzle. To create a strong trading strategy, mix them with other aspects and analysis methods. Thank you for watching, and don't forget to subscribe to our channel, TraderYodha, for more insights and updates. Bye for now.